We're going to talk about several accounting concepts, and the first one is the accounting period concept. Because businesses need periodic reports on their affairs, accountants slice time into small segments and prepare financial statements for specific periods, such as a month, a quarter, or a year. The basic accounting period is 1 year, and all businesses prepare annual financial statements, like the income statement, statement of owner's equity, and the balance sheet, at least once a year. For most companies, the annual accounting period runs the calendar year from January 1st through December 31st. Other companies use a fiscal year, which ends on a date other than December 31st. The year end for a company is usually the low point in business activity for the year. For example, many retailers use a fiscal year that ends on January 31st because their low point of activity comes about a month after Christmas. Companies also prepare financial statements for interim periods. This means they create financial statements for a period of less than 1 year, such as monthly, quarterly, and semi-annually. A company that is traded on a stock exchange like the New York Stock Exchange or the NASDAQ, they must release their financial statements quarterly. So investors of those companies eagerly await to see the company's new income statement and balance sheet every quarter. That's so they can see how their investment is doing. So before the financial statements can be prepared, accountants need to update the accounting records. This is done through adjusting entries. But I'll give you an example of why you need to do an adjusting entry. Let's say it's January 1st and you buy 12 months of insurance. So you're prepaying for insurance. So you increase the prepaid insurance account by 12 months worth. Then if the company decides to make financial statements monthly, at the end of the month, that prepaid insurance account is no longer accurate. So you must lower that prepaid insurance account by 1/12, in other words, whatever 1 month is worth, and then you need to increase insurance expense. So that's the adjusting entry that you would do at the end of January. Again, we'll get to that more in detail later. Now let's talk about the revenue recognition principle. The revenue principle tells accountants when to record revenue. That is, when to make a journal entry for a revenue and the amount of revenue to record. Recording something in accounting just means making an entry in the journal. So the revenue principle says to record revenue when it has been earned, but not before. Revenue has been earned when the business has delivered a good, in other words, a product, or a service to a customer. The company has done everything required by the sale agreement. That is, the earnings process is complete. So you record revenue when a service is provided or the product is delivered. Now, this is not necessarily the time when cash is received. Remember, if you provide a service like you mow someone's lawn and you agree to let them pay you 2 weeks later, even though they haven't paid you, when you're done mowing the lawn, that is when you record the revenue. So let's talk more about the revenue recognition principle. This exhibit shows 2 situations that provide guidance on when to record revenue for Smart Touch Learning. So Smart Touch Learning is offering QuickBooks classes. So QuickBooks is just an accounting software. So in situation 1, the client signs up for the class. He has not taken the class, so Smart Touch Learning has not provided the service yet. So does Smart Touch record revenue yet? No, because they've not provided the service. In situation 2, the client has finished the course. Should Smart Touch record revenue now? Yes, they provided the service, so they should record the revenue, whether he pays them now or whether he pays them later. It does not matter. As soon as you're done performing this service, you record revenue. Now let's talk about the matching principle. The matching principle guides accounting for expenses. Expenses such as salaries expense, rent expense, utilities expense, advertising expense are all necessary in order to earn revenue. The matching principle measures all the expenses incurred during the period and matches them against the revenues of the period. A classic example of using the matching principle comes later when we learn about depreciation and depreciation expense. Remember how when we buy a truck, let's say we have a truck that we're going to use to deliver things with for our business. When we buy the truck, do we expense the truck? No. The truck has a future value, therefore we record it as an asset, probably called truck. But does that truck maintain its value over the years? No. The more we use it, the less value it has. It will eventually wear out. So each year we have to record part of that cost of that truck as depreciation. So later on we'll show that we lower the value of the truck gradually through a process called depreciation, and then we record that as depreciation expense. So basically we're gradually taking the asset, the truck, and turning it into an expense called depreciation expense, which will lower our company's profits, which lowers our taxes too. Other expenses are not so easy to link to revenues. For example, monthly rent expense occurs regardless of the revenues earned that month. The matching principle tells us to identify those expenses with a particular period, such as a month or a year. The business will record rent expense each month based on the rental agreement. So again, let's say we prepay $1,200 for a full year of rent. I guess that's really cheap rent, $100 a month. Anyway, so we would record $1,200 as prepaid rent, and then the matching principle says that each month we need to show that we've used up 1 month's worth of that prepaid rent. So we would lower the prepaid rent account by $100 per month and then increase the rent expense account $100 each month. Again, we'll go over this more in detail, but I just wanted to show you what the matching principle has to do with accounting. Another concept is the time period concept, which is closely related to the accounting period concept. This concept requires that accounting period information be reported at regular intervals, for example, annually, quarterly, or weekly, and accounts must be updated at the end of each accounting period. So remember, this is key. Anytime you're going to create your financial statements, you have to update your accounts. For example, if you prepay the rent for the full year, you're going to increase an asset called prepaid rent. And then each month, you need to lower prepaid rent by 1 month's worth and then increase rent expense by 1 month's worth. So that's what we're going to learn next, is how to do all these different types of adjusting entries. And once you get to see them and do some practice with them, they pretty much become common sense.